Hello again, it's Harry Swaminathan. We want to look at our Herbalife trade now because markets have definitively taken a negative turn. So we don't know how long it'll last, but as of now, I think all our trades have been set up quite well, except for Herbalife. In the sense, Herbalife was an earnings trade which sort of didn't go our way, and then we had to turn it into a short strangle, and we got a good time decay out of this, and so now we are back to even, just a minor profit there. But if you take a look at the risk graph, let me close that up. If you take a look at the risk graph, we are right here. So it's definitely in the center, but what is the problem with this trade? It's a naked strangle, and so you don't want to leave a naked strangle out there, especially when market sentiment has changed suddenly. So how do we adjust this? So now let's take a look at this position first. We have a current profit of 26.45. However, we booked a loss of 2,500. So we are just about a little over break even. So, but if you look at our max profit, it's 9,500 right here. So we have a lot of profit here to capture. Inside this long strangle, we have a lot of profit to capture. So the way we protect it is, if you look at how much time is left on this trade, we have, sorry, went to the wrong screen. Herbalife has 36 days left to expiry. So now our goal is to protect it for at least 30 out of those 36 days, and perhaps we'll close it a few days before expiry. So the way to do it is, there's two ways of looking at this kind of an adjustment. How do we protect Herbalife? So let's take a look at them. So if we can go into the same September series, and we can buy some long puts and some long calls. So we know our break even is somewhere here in the 55 range. So if you wanted to buy the 57.5 put, you would pay $1.56. And then if you wanted to buy the 75 call, let's say, you would pay about $1.34. Or even the 80 call, you're going to pay somewhere. Even the 52.5 70 cents, and the 80 call is 75 cents. So you'll pay about $1,500 for this. A better option, I think, is let's go into the weeklies that have 15 days to expiry. So that's about 2 weeks from now. And if you look at a similar option, the 55 and the 80, it's about 20 cents, or even the 75 is just about 36 cents. So for the next 15 days, we can buy protection with these options. So let's see what we're doing here. I'm buying the 80 call and the 55 put. Yeah, the 80 call. Why does the 80 call make sense? Because our break even is right there. So, whereas on the put side, it's near 55. So I want to buy the 55 put and the 80 call. So I haven't turned this on. If I turn this on, see what happens to this graph. Now we have a couple of different expirations here. So, we have to put the +2 expiration. This is where we are currently. And over the next 15 days, you have to look at the red line. And so, if the markets, if Herbalife crashes, you can see the red line is capped right there. And, that's the graph we'll be following over the next 15 days. And how much do we pay for this protection? For 10 contracts, we're going to pay $440. Whereas if you went to the September series, you were going to pay at least $1,500. So this is $440. We buy this protection, and this protection is valid for 15 days. And if we have to do this again after 15 days, we can do that. So, but this is a better way of protecting at a lower, you're basically buying cheap insurance, but very effective insurance. Just because it's cheap, it doesn't mean it's not good. It's very, very effective insurance. So that's what we're going to do on Herbalife. So I'm going to create this order and buy the protection that we need at the edges of this trade. Thank you.